Hi everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show where we help you out with your personal finance questions and queries. So don't forget, you can write into us on The Money Show at etnow.tv. The theme for today is going to be about investing in non-Indian markets, investing in overseas markets, be it the United States, be it Japan, or what have you. And now, of course, thanks to several fintech, apps, thanks to various digital medium, it's become easier to put your money into overseas markets. You can do so by investing directly in stocks, or of course, you can also invest in Indian mutual funds that do have a salience to global markets. We have several Indian mutual fund houses that are global funds that invest in global securities. So two ways of doing so. How should you do so? Which should you pick? How much of your portfolio should be in these overseas securities is what we'll be discussing on The Money Show today. If you'd be interested in knowing more about it, or if you already have some, US or global funds and you want to know what to do with them, especially because they've seen quite a rally in 2020, send in your portfolio on The Money Show at etnow.tv. And keeping it with our theme on investing in foreign markets, there is one fund in India that does not classify itself as a global fund. It in fact is a multi-cap fund, but it invests in the bluest of the blue chip technology stocks in the United States. In fact, these stocks have been responsible for the rally that we witnessed in the NASDAQ in the United States for the first 8 months of 2020. It boasts of having stocks like a Google, an Apple, so on and so forth. This is the Parag Parakh Long-Term Equity Fund, and that's whose manager we'll be talking to in our Meteor Fund Manager segment. So like I said, action-packed day right here on The Money Show. But first up, ET Now always thinks of you, the viewer, first on how to get rich as well. And commodities guru Jim Rogers shares his tips on how to get rich. He does remain cautious of not investing in the unknown, and he believes that it's always better to gain 1% than to lose 2-3% in a year for obvious reasons. Listen in.
I have the same problem. Everybody in the world has this problem now. It's a time that has never existed in world history, when major interest rates have been zero or even negative. So it's very difficult for everybody. But my answer is, don't get too confident. Don't try to reach for something, because it is better to earn 1% a year than to lose 3 or 4% a year. And if you start investing in things you do not know about, you're going to lose money and you're going to suffer. I don't like it either. None of my friends like it. But be very careful, because when it ends, and it will end someday, many people are going to suffer badly.
Okay, let's now kickstart the show by taking on board our topic for the day, and that's investing in overseas markets. It may sound a bit more complex and difficult than it actually is, thanks to the emergence of financial technology, different platforms, digital media as well, that has made it possible now for the investors to very easily directly pick and choose stocks itself in the US markets. But of course, should you be doing that? Who are the individuals who are actually capable of doing something like this? Stock picking, that too not in a market that that's the Indian market, but the United States market. And finally, of course, should you rather invest in the overseas markets via a tried and tested mutual fund route, where once again the funda remains the same? You have your astute fund managers with their stock picking skills who deploy the same, with of course a few geographical tweaks, since it is the overseas markets, to pick overseas stocks and securities. Let's understand all of this and more with Mr. P.V. Subramaniam. He's the CEO of Subramani.com. Mr. Subramaniam, always a pleasure having you with us on The Money Show. So to start with, do you think that for Indians, for all our retail investors watching, whose aim is to create wealth for the long term, for retirement or any long-term goal, do you think that it's a good idea to have certain non-Indian securities or some exposure to overseas markets?
Mubina, you think you can keep people away from the markets, international markets? There is FOMO, right? Fear of missing out. So everybody today wants to do something in the international market. If you see the number of fund houses launching new schemes and the amount of money that they're collecting, obviously everybody wants some part of it, right? So yeah, people are investing. Do they need to do it? No. And but yeah, they will continue to do. So what you say doesn't really matter. People will continue to invest in foreign markets.
Okay. But are you a proponent? I mean, do you think that it's
not,
something that
not
would perhaps,
unless
we always talk
person,
about asset allocation, we speak about diversification.
Not unless the person has set up at least $1.5 million, which means about 10 crores, then maybe yes, but otherwise not needed at all, not necessary, because also it's more difficult to understand. The risks are more. But like I said, it doesn't stop people from investing. Everybody is investing in some way or the other, but yeah, people are investing.
Oh, for sure. And, I mean, I think people are all the more going to get tempted, or as you said, will get that FOMO feeling, especially if they look at the kind of returns, right? I mean, you have some of these funds as well, Indian funds that invest in global securities that have given bumper rallies, especially in the first half or up until the first 8 odd months of 2020. So all the more, I guess, it's something that is tempting.
Especially the US market.
So
especially the US markets.
Yes, go ahead, Mr. Supreme.
No, I've said especially the US markets. As far as Indians are concerned, mostly investing abroad means investing in US. Very few people have invested in Europe or Asia without Japan, China. Very little money, but yes, there are fund houses like Templeton who have Asia fund, Europe fund, and a US fund. So yes, they have schemes, but yes, predominantly, I think it is the US market because Motilal Oswal, Templeton, all have big funds which have all raised more than 1,500 crores for investing in the US market. Yeah, so US is big, but yes, there are people who are investing outside of US also.
Yeah, but I guess it's the most popular, it's the most commonly benchmarked market as well, the United States market.
It's the market which has
let's just give in to people's temptation to know more about the US markets, and to just investigate a bit more over there. Even if, let's say, an individual does want to test those waters, and he or she believes that, okay, maybe I can try my hand out. I'm sure you believe that there will be some strict amounts beyond which an individual should not really go and experiment in international markets?
Look at it this way. If I were to invest in gold, it's again an international product. If I were to invest in energies, it will have to be an international market. So DSP has some funds which are investing in gold mining and all that. Those you don't get in Indian market. So there you don't have a choice. Similarly, you can have a healthcare fund which invests in US health companies and US pharma companies that you can't get with Indian. No Indian companies are growing very fast. So if you want fast moving companies like Facebook and all, you don't get. So yes, like how much you put in debt and gold, maybe you should put not more than 20% of your money into foreign markets. When I mean foreign markets, I mean Asia, I mean US, I also mean debt markets. I think one of the fund houses has a fund which invests in international equity and international debt. Maybe there's just one such scheme. So you have to look at a combination of this. And I think PGIM and ICICI have funds which invest in global equity. So they would put, say, 30% in US, 20% in Europe, 10% in China, or whatever, some combination. So such funds are also available. All that put together should not be more than 20% of your total liquid net worth that you are investing.
Not more than 20% of your total liquid net worth, can be invested in the overseas market. Direct stock investing and, via Indian mutual funds. I mean, I guess the funda really remains the same, right? I mean, if you don't have that savviness to invest in or to pick stocks in the Indian market, it would probably be even more difficult if you try and venture and, try out your hand in the overseas market. So, do you believe that, the mutual fund route that, Motilal Oswal, Franklin, etc. offer should be the best one because it's tried, tested, and again, you have the experts who are going to manage your money?
Absolutely. Because of two things. One is Internationally, you don't understand what is happening, so stock picking becomes difficult. And during such markets, when only few shares like Google and Facebook, etc., have gone up, there's a temptation to keep on buying them. You're much better off taking the mutual fund route. There's another small problem. If you die interstate abroad, leaving money there, first of all, no estate duty will be applicable if you are in India, but the chances are if your children are studying there and you made them the nominee, then they will pay a huge 40% estate duty. So there are tax implications apart from the skill of picking stocks. So even if you see Indian mutual funds, they are investing in funds there. Of course, there is one fund of Templeton which is picking up stocks. Then there is Parag Parekh who is picking up stocks, and Motilal Oswal who is picking up the index stocks. But other than that, picking up stocks in a foreign market with a foreign fund manager, we may not have the skills. So you're better off going with the mutual fund route. Picking direct stocks requires skills. There are people who have been living there and who have come back. Maybe they can try their hand, but it is not meant for the common man. There is this LRS where you have $250,000 available for you to invest. That is one possible route. But remember, there is TCS, tax collection at source there. And you can be sure if you invest through the LRS route, your case will be picked up for scrutiny because government is going to see a kaun hai itna amir aadmi. So you will attract attention also for sure.
All right. Mr. Subramaniam, what sort of additional risk would an individual be taking on if he or she decides to invest in overseas markets?
So first of all, straight away, there is currency risk, right? We have always assumed that the dollar will always go up against the rupee. What suddenly if the dollar does not go up? What happens if the dollar comes down? We are not prepared for those things, right? So what happens if really the dollar comes down? Then you may make 10% return and you may lose that in the exchange risk. So that is one risk which is there. And take the worst case scenario. America decides that you cannot remit this money outside. America has done it in the past. It did it to Iranian investments. It has done it to Pakistani investments. What happens if US decides that you cannot take this money out of US? So these kind of risks you run. Those are extreme, but straight away it is currency risk. We always assume that the dollar will appreciate against the rupee. If it goes the reverse way, we are in trouble.
I mean, if you take, for example, what's happened right now, right? I mean, we've seen a bit of appreciation come in the Indian rupee versus the US dollar. So it's not necessarily really that, every single time you are going to see the dollar really appreciate.
Especially if you're a short-term
Though, of course, in the long term, it does definitely look like that's the trend.
Yeah.
Absolutely. All right. Okay, well, just one last question from my side, of course, and then we can go on board with our viewer queries as well. We've received, remember folks, that you can write into us on the Money Show at etnow.tv. Mrs. Subramaniam, is there any difference in tax treatment whether I'm investing in, let's take US for example, for convenience purpose, whether I'm investing in US stocks or whether I'm investing in these funds that in turn invest in US stocks?
See, it is very clear that when you invest in Indian mutual funds, you will be treated like a debt fund. You will not be treated like an Indian equity fund. You will be treated like an Indian debt fund. Unless the fund has decided to invest, I think Nippon has a fund which invests 65% in Indian equities and 35% in American equities, like your PPFAS also has that, which is 65% Indian equities. Then it doesn't really matter. You pay tax like Indian equity. Otherwise, it will be treated like Indian debt fund, which means it will be long term after 3 years. However, if you invest in the US directly, you will have to worry about US taxation, Indian taxation, understanding the direct tax avoidance agreement, and that your chartered accountant will have to know. When you buy and sell, what is the implication of capital gains tax? There'll be some tax deducted there and some tax on the dividend, which is called the withholding tax. You will have to understand that and claim the relief while filing your return. It gets a little more complicated when you do direct investment. When you invest in Indian mutual funds, then it is taxed like only Indian law applies. The US law does not apply to you.
Okay, well, on that note, we'll take a very short break right here on the show. Don't go anywhere.